Now let us understand what is goodwill in partnership. Goodwill is what? Goodwill is the reputation of the business firm. Now reputation, how it is built over a period of time. Now people get satisfied due to the product quality, due to the service quality, due to the consistency of the quality of service, the after service, after sale service. What are all those things create a reputation of the organization, and this reputation helps in getting over and above the normal profit what other organization in the same industry gets. If there is no such monetary value, that additional benefit, then there is no goodwill. So goodwill comes if there is some extra profit comes because of those extra services. So in simple term, this is the reputation of the firm, and this reputation, how it reflect? It reflect by way of future profit, what is expected, and which is more than the normal profit. Normal profit is what? The normal rate of return what other organizations get in the same industry. Now your average profit for an organization, the average profit shows more than the normal profit what other organizations are getting, means there is some goodwill of that firm. That could be the quality of service, could be the quality of after sale service, or the quality of the product itself. So all these make them different from others. Now if that value comes, the people who have worked in the past created that value. So new partner comes, if a new person comes, he has to give that value, that additional value to the people who have built it, and for that reason the goodwill is getting value. So from that perspective you can see what is the necessity when it is arises. When there is a change in profit sharing ratio, if there is a change in constitution, change in partners profit sharing ratio, at that point of time this goodwill valuation will work. Also it works on when there is an admission of a partner or a retirement of a partner. If the partner dies, if the partner dies, then also the legal heirs will get the money. So in that case also goodwill valuation is required. Otherwise, if the firm get dissolved, at that point also the goodwill valuation may be required. Now, what are the methods we do the valuation? One of the first simplest method is take the average profit. What is average profit? Take the average profit of the past few years. Remove the abnormal situations. Take the normal situation of that. If there is any sudden natural calamity comes, or sudden spike because of some reason comes, you do that abnormal effect you need to remove. Take the average profit. That in that average profit into certain number of years purchase. It is called years purchase because the goodwill is calculated that much of value going to be received by the firm over the next few years. Maybe next 3 years, this rate of growth will continue because of the past benefit. That is what the goodwill. The average profit multiplied by the number of years purchase will be the goodwill. So let's understand what is written here. Profit of the past few years are averaged and adjusted for any expected change in the future. Also, any, like I told, abnormal situation, there could be expected change. Now, say the firm decides that, looks at that the industry is growing at the 10%. If the industry grows, the firm also will grow. Over and above, because of their goodwill, they may expect that the firm will grow at 15%. So that growth on the average profit you should factor in. How do you factor? Build some weighted average. Instead of simple average, you can do a weighted average, factor it. So various ways you can factor it. You take either simple average or weighted average. If you see that there is a growth path, it is better to take the weighted average. If there is no growth, it's the same figure is coming most of the years, similar, then average, simple average is good. Goodwill is calculated on the basis of average profit multiplied by the number of years. Simple. You expect for next 3 years, this will continue, this growth rate will continue, so multiply. Implication is that such profit will be maintained for so many number of years. That is what they are telling. Now, partners who gain in terms of this profit sharing ratio should contribute for such gain. Means if there is a change in profit sharing ratio, the partner who get more profit share, he should pay this goodwill value to the existing partners for their past contribution. Next method is super profit method. Super profit is what? It is the excess profit that a firm can earn over and above the normal profit because of this goodwill. Usually it is earned by similar. Now what is normal profit? Normal profit is what other industry is taking. Let's say For same, so let's say garment industry in a particular market, the dress materials, many shops are selling. So on an average, they have a profit. Now in a particular shop, if it is getting more profit, there must be some reputation is there. So that normal profit, other firms, other shop owners, what they are getting is a normal profit. It could be 20% on the capital they are getting. Now the one particular firm may be getting 30%. So that is because of their reputation. So that is the super profit. So it is the excess profit that can be earned by the firm over and above the normal profit usually earned by the similar firms. Now here also the partner who gains in terms of the profit, he will pay that benefit to the person who are sacrificing that. The profit sharing has to contribute only for the excess profit. Now when you calculate the super profit, why do we do that? We do it because the persons who are gaining, if there is any change in constitution or a new partner comes, who will gain, take the benefit of this from the day one. Some people have worked for 10 years, maybe they got this goodwill. A new partner comes from the day one, he get the benefit. So he should give that benefit for the goodwill value to the existing partners. Now how much they will give? He will give only that super profit portion. The normal profit he would have earned doing the business in his own. So that super profit element, he will be sharing it to the other part. Normal profits otherwise he could have earned from the industry by doing the same business. So how do we do that? First determine the excess profit. The firm what can earn because of this goodwill. Identify the capital employed. Identify the average profit earned by the partnership firm. Determine the normal rate of return. Apply the normal rate of return on the capital employed. Now all these figures you will be getting in the problem. Well, capital employed will be given. Average profit earned, they will give that year wise 2 or 3 years profit. You need to do the average, whether simple average or weighted average. Then determine the normal rate of return. Normal rate of return also will be given. In real life, you have to determine. In the problem, in the exam, you will get this figure. Apply the normal rate of return on capital employed. Deduct the normal profit. That will get the normal profit. That normal profit from average profit. This average profit is more than the normal profit, then there is a super profit and goodwill exists. If it is less, there is no goodwill. Goodwill should be more, it cannot be less. Now how do we calculate? There are two methods. Number of years purchase, or it can be done by annuity method also. Number of years purchase, simple. Average profit, how do you calculate? Every whatever years is given, make a sum divided by the number of years. If it is weighted, put the weight and take the cumulative weight, divide by the cumulative weight. Now normal profit, capital employed into normal rate of return. Rate of return will be given to in the problem. Super profit is the average profit minus normal profit. Now goodwill is what? This super profit into number of expected number of years of profit, and that also will be given in the exam. If it is not given, you might have to take some assumption. Another method is annuity basis. What is annuity? Annuity is something like you get in a periodic manner same amount over a period of time. Let's say you get a super profit every year 20,000, 20,000, 20,000. Now today's 20,000, next year's 20,000 not having the same value. Next year you understand the discounting factor in your math and stat you have learned. So basically what you will do today when you do the valuation, you will do a discounting effect. That discounting factor what you apply is nothing but the annuity value which you get from the annuity table. In your exam they will give the figure. What is the value for that? Let's say if it is 3 years goodwill you want to calculate, 3 years discounted factor by way of annuity they will be given. So what they are written here, when the money to be received in different point of time, its value should be different depending upon the rate of interest, that is rate of discount or discounted value. Annuity means identical annual amount of super profit. So identical amount, every year 20,000 more you are getting. So if that you discount it, that discount rate is you get from annuity table. In your exam it will be given. Fourth method is capitalization basis. Capitalization is what? Again we calculate it based on the normal rate of return. We know how much capital is employed and we also calculated what is the average profit. If we apply the average, our average profit divided by the normal rate of return, what we get? The business value. In the current market scenario, what is my business value? What others are getting the rate. In that rate, if I deploy my profit, we divide my average profit by the rate what others are getting. So I get a value. This value will be, because others are getting less than me, this business value will be more. This business value minus the actual capital employed will be the super profit. So value of the whole business is determined applying normal rate. How do you do? Difference between such value and capital employed is a goodwill. What you will do? Determine the normal rate of return, which will be given in your exam. Determine the average profit. Again, they will give the profit, you need to do the average, for which the goodwill is to be determined. Calculate the capital employed by the partnership firm. The capital employed also will be given in the problem. Find out the normal value of the business by dividing the average profit by the normal rate of return. So what you will do? Average profit divided by normal rate of, that will be the business value. Deduct the average capital employed from the normal business value. That will be your goodwill. So that's how. So there are these four methods we will be valuing goodwill, irrespective of the goodwill valuation is required in change in constitution or admission of a partner, retirement of a partner, death of a partner. Whatever be the situation, the valuation methods, either of these four will be applied. So let's understand this with the form of an example. Let's solve this problem so that we will understand how the goodwill is calculated. Let's read it. A and B are in equal partnership in Messrs. AB Limited. They agree to take C as 1/4 partner, for which goodwill is required to be calculated. They have given the profit for last 4 years. It's an annual year they are doing accounts. This firm is doing January to December, and 31st December capital employed of AB was given 5 lakh. Normal rate of return given as 20%. Valuation for goodwill, they have already mentioned that you assume 3 years purchase. So you have to multiply by 3. Actually, after arriving the super profit, multiply by 3. Annuity rate also they have given for 3 years at 20% is 2.106. We need to multiply that. We need to take this factor and do that. So compute the goodwill in all the four methods. So first we will take average profit method. So what we do? Average profit. Here if you can see, here you see that the profit is increasing 1 lakh, 1,15,000, 1,25,000, 1,50,000. Gradually it is increasing. So it's better we should take a weighted average. So we will take this year, then profit. We will also take the weight. To 2019 to 22 it is given. 2019, 2020, 2021, 2022, and profit figure given here 1 lakh, 1,15,000, 1,25,000, and 1,50,000. Let's take the weight as 1, 2, 3, 4. So gradually the profit is increasing. We are giving more weight to the higher profit. To the latest year we are giving more weight. So we'll take the weighted profit. First year 100 into 1, 1 lakh into 1, so 1 lakh. 1,15,000 into 2, so it is 2,30,000. 125 into 3, so 3,75,000. Then 1,50,000 into 4, 6 lakh. Total comes to 13,05,000. This 13,05,000 we also take the weight total. Weight total is 4, 3, 7, 8, 9, 10. So weight is 10. So we'll take the average profit here. Let's take the average profit. 13 lakh 5,000 divided by 10. So 1,30,500. This is our average profit. Now goodwill, they have told that consider at 3 years purchase. So goodwill at 3 years purchase is equal to 1,30,500 into 3, that is equal to 3,91,500. So that is our goodwill based on average profit method. Now next method what we understood, super profit method. Super profit method, how we calculate? We calculate we take the average profit, we take the normal rate of return, what is the profit they are getting. So difference is your super profit. Average return we know, so normal profit we will calculate here, average profit is, we just calculated 1,30,500. Now normal profit, normal profit is the capital employed into normal rate of return. Normal rate of profit is 20%. Our capital employed is 5 lakh. So 5 lakh into 20%, that is 1 lakh. So what is our super profit? Super profit is 1,30,500 minus 1 lakh. So that is 30,500. Now goodwill is 3 years purchase. So 30,500 times 3, that is 91,500. That is your super profit method. Now the same thing when you do this based on annuity method. So now we'll do the annuity method. In annuity method what we'll do, what they say is that same profit they are expecting over a period of time in the same way. So in this case we will assume that this super profit will come in the every year same. So we'll take the super profit, yes, we have just calculated 30,500. Now we'll see the annuity rate. Annuity rate given in the problem for 3 years purchase at 20%, 2.106. So annuity rate is equal to 2.106. Now if I take this goodwill, yes, 3 years purchase, which we have already taken the average. So in this case 3 years purchase rate we have got 2.106. So 30,500 into 2.106, which comes to, we'll do in calculator, 30,500 into 2.106 comes to 64,233. So got 64,233 in annuity method. Now next we are going to understand capitalization method. Capitalization method. Under capitalization method what we'll do? Under capitalization method we have to take the business value under normal interest rate. The normal rate will apply on the average profit to get the normal business value. So take the normal value of the business is equal to what? Average profit divided by normal rate of return return. So this comes to average profit. We have calculated here first 1,30,500. We'll take 1,30,500 divided by normal rate of return 20%. So if we do that, 1,30,500 divided by 20%, it comes to 6,52,500. 6,52,500 is my normal business value. Capital employed is, we know, capital employed, it is already given in the problem, 5 lakh here. So we will take this 5 lakh. What we are trying to do here basically, so I have deployed 5 lakh. Today the return market is getting, other people are deploying 6,52,500, they are getting 1,30,500. But I have deployed only 5 lakh, I am getting 1,30,500. So I get a more profit. The people have put more money, getting the same amount of profit, which I am putting less money and getting. So that is my goodwill. So in this case, my value is 5 lakh, whereas others, if I would have done the normal profit like others, I would have invested 1,52,000 more. So my goodwill value is that difference. So goodwill is 6,52,500 minus 5 lakh, which is equal to 1,52,500. So you can understand now that each method you deploy, you get a different valuation of goodwill. So depending on the nature of business, you have to choose the right method and then find the goodwill. Applying these 4 methods, wherever you get admission, retirement, death, dissolution problem, the same methods will be applied and they will mention which method to be applied. Hope you understand the problem. In the similar manner, we will try to solve some more problems. If you like this video, please do subscribe and share this, and also put the bell icon so that whenever I post another video, it will come to you. You will get a notification for that. So see you soon with the next video. Till then, thank you.